Hello and welcome to my masterclass. I am Marco Trades and I'm going to be showing you guys exactly how I use liquidity on a daily basis on the charts. So we're going to start all the way from the beginning. We want to understand the core concepts of liquidity, the foundational aspects of liquidity. So I'm going to go into it, explain to you guys how I use it, different forms, and then all the way at the very end of the masterclass, again, we're going to be putting all of this together into one video, all the concepts together into one. And I'm going to show you guys exactly how I approach the market on a daily basis. First off, we're going to start with the introduction to liquidity. Again, I need you guys to understand the basics of how I use liquidity, and then we're going to move into some more advanced concepts moving forward, but we need to understand the basics first. Okay, so we have the introduction to liquidity. This is going to be the first lesson. So liquidity as the market's fuel. Okay, I need you guys to remember that for the future. Liquidity is the fuel that allows the market to function. Without liquidity, price cannot move, expand, or sustain directional movement. Okay, so basically, we use liquidity as our direction, as our bias, and then again, all the way to the end for our entries. Okay, but how we use it determines our direction, and that's very, very important. Okay, because with no liquidity on the charts, then how do we know where price is going, right? So every transaction in the market requires participation on both sides. And that participation comes from orders resting in the market. When liquidity is present, price can move efficiently and decisively. When liquidity is absent, price slows down, pauses, or moves sideways. Okay, as you guys can probably tell from your own experience in the charts, when we have big moves in the market, okay, whether we're moving aggressively to the upside or aggressively to the downside, usually following those big moves, the market tends to consolidate or range, right? Why does this happen? That's simply because there is no liquidity on the charts. There's a common saying out there in the industry is if you can't see the liquidity, you are the liquidity. Sure, I guess that's right in a sense, but what I need you guys to understand is I'm not always going to be trading because liquidity is not always going to be present on my chart based off how I see the markets, right? So again, when we have those big moves to the upside or those big moves to the downside, typically there's not going to be any liquidity on the charts anymore. So that's why the market will range, again, consolidate, build that liquidity in order for the market to move again. Just like a car cannot move without gas, the market cannot move without liquidity. So great analogy there. Very simple, very straightforward, right? The market cannot move without liquidity. That's just how we use it. Again, it's a theory, but how we use it. You can press the accelerator as hard as you want, but without fuel, nothing happens. In the same way, expectations, bias, or analysis mean nothing if the market does not have enough liquidity to support the movement. Understanding liquidity is not about finding entries, it is about understanding what makes movement possible at all. What liquidity actually represents. Liquidity exists as money at risk in the market. It represents capital that is committed through open positions and resting orders. Most commonly, this liquidity is found in stop losses placed by traders who are already positioned, as well as stop orders waiting to be triggered. So that could already be positions already in the market, or it could be pending positions that are not activated yet, whether that's a buy limit, a sell limit. Just basically you're waiting for that order to be filled, and then again, you're in the market. So we view that, of course, as liquidity as well. Those stops represent money that will be forced into the market once price reaches certain levels. Okay, so again, that's just how we identify liquidity, right? When stop losses are triggered, that money is released into the market as liquidity. This release of liquidity allows price to move. So usually if you have a buildup of highs or a buildup of lows, we view that as liquidity at the highs or liquidity at the lows, right? So that what tends to happen is price will take out those lows and go up. On the opposite side of the spectrum, price will take the highs and then go to the downside, right? It's pretty simple, pretty straightforward. For the people here that are not new to liquidity, that side of it is very common. It's very basic, right? The market does not move because traders are right or wrong. It moves because liquidity has been made available. Once enough liquidity is accessed, price is able to expand away from that area, often in the opposite direction of where stops were triggered. Again, take the highs, run for the lows, take the lows, run for the highs. Quite simple, quite straightforward. This is why stop losses are so important to market movement. And honestly with you guys, that is probably the most important type of liquidity I would look for, right? I view the market as buyers have stop losses here and sellers have stop losses here, okay? And you guys will understand that more and more as we go forward with this. They are not just risk management tools for individual traders. They are the fuel that the market needs to continue moving. Until those stops are triggered, price often struggles to go anywhere meaningful. Once they are, the market has what it needs to make its next move. Liquidity is observable, not opinion-based. There are many beliefs about what drives the market. Some believe institutions are responsible, some believe algorithms control execution, and some believe it is a combination of both. Guys, something I want to touch on real quick is it really that important to know the exact why? And that is what a problem a lot of traders have, is they need to know why the market is doing this. At the end of the day, just like any strategy out there, no one knows what's actually happening behind the scenes. But again, it's always a theory. No one knows if it's algorithms. No one knows if it's this or that. These are all just theories at the end of the day. The reality is that no one can definitely prove who initiates every move. What can be consistently observed is that price requires liquidity to move. And you guys will see this going forward. It's just a very, very common theme. Regardless, the market cannot expand without orders. Liquidity is the common denominator that explains price behavior without relying on assumptions. Price requires liquidity to travel. Price does not move freely or infinitely. It must travel through areas participants exist. So again, just like I view buyers to have liquidity at the lows and sellers to have liquidity at the highs. When price leaves one area, it does so because liquidity there has been consumed. It approaches another area, and it is because liquidity exists ahead. Just like how lows are run, we run for the highs, vice versa. This creates a natural flow in the market where price moves from one pool of liquidity to the next. Understanding this removes randomness from price action and replaces it with structure. Liquidity pools give price purpose. Liquidity pools form whenever large numbers of orders accumulate. These pools act as destinations for price rather than predictions of direction. Price is drawn towards these areas because they provide the fuel required for movement. Once liquidity in a pool is accessed, price can either continue or pause depending on whether additional liquidity exists. This explains why price often reacts around specific zones rather than moving endlessly in one direction. Why the market moves in phases. Like we talked about briefly at the beginning of this lesson, the market would not just continuously rocket to the upside or continuously sell to the downside. When these big moves occur, again, typically what happens afterwards is we have that rangy price action, that consolidating price action. That's where a lot of traders get chopped up. That's where a lot of traders blow their accounts because they lack the patience to understand the market will move to the upside, yes, but then it needs to range in order to move higher or reverse back to the downside. Okay, it's just a common theme in the market. And again, we kind of use it as phases, you can call it. But again, the market does not move in a straight line. It moves in phases based on liquidity conditions. When liquidity is sufficient, very important, price expands. When liquidity is insufficient, price consolidates or ranges, right? You guys, again, if you have a little bit of a background coming from liquidity, you'll understand this. You'll notice that this happens a lot of the time. These phases are not random, they are functional. The market adapts to its environment, slowing down when fuel is limited and accelerating when fuel becomes available. What this module intentionally avoids. This module does not focus on entries, setups, or trade execution. It is designed to tell you when to buy or sell. Its purpose is to reshape how you view price movement. Before execution can be refined, understanding must come first. Liquidity provides that understanding. I know a lot of you guys are eager here to understand how people enter the markets. That's kind of the perspective I used to have a long time ago. But what you need to understand is liquidity, again, provides us our direction and our bias in the markets, right? And that is the most important part. Something we're going to talk about in lessons moving forward is I'm never going to tell you guys that you need to be catching tops and you need to be catching bottoms, because at the end of the day, the most important part of trading is having the correct direction, not the most perfect entry. And that's what we're talking about here, right? Before execution can be refined, understanding must come first. Liquidity provides that understanding. Okay, so you need to understand this all first in order for us to move on. Core understanding to carry forward. Liquidity is the market's fuel source. Price moves only when that fuel is available and pauses when it is not. The market transitions between phases based on liquidity conditions, moving from one pool to another as participants allows. Every module that follows will build on this foundation, adding clarity and precision to how the market framework is applied. Okay, so that concludes lesson 1 on liquidity. Again, a lot of just text and font in front of your face, I know. But again, I want you guys to understand that core foundation of liquidity, basically the why, right? The why of why we use liquidity, how we view it, right? And again, we're going to move into the charts and show you guys how to apply it, of course, but make sure you understand this lesson before we move forward.